Our next reading is non-current liabilities or long-term liabilities. There are about 50 plus questions in this reading. The first question, the present value of benefits earned during the current period by the participants in a defined benefit pension plan is best described as what? This is basically the definition of service cost. Service cost basically is the present value of benefits earned during the current period by participants in a defined benefit pension plan. Okay, that should be the right answer. Then what about the past service cost? Past service costs, on the other side, are the benefits earned during the past periods by the participants of the defined benefit pension plan. So it's just the difference between present and the past. What about the net pension liability? The net pension liability is basically the difference between the total pension liability, that is the present value of the projected benefit payments to employees based upon their past services, and the assets. In other words, the net pension liability is equal to expected benefit, that is the present value of projected benefit, that is the payment to employees based upon their past service. If it is greater than the plan assets, it will result in net pension liability. What about the net pension asset? It is the other way around. When the plan assets are more than the expected benefits of the pension plan. So C is the correct option, and C it is. Next, Crawford Corporation is a lessor. Crawford classified a lease as a sales type lease. It is most likely that Crawford has significant. First of all, let us see the differences between IFRS and the US GAAP. US GAAP has three classifications now. First, operating lease, finance lease, and the short-term lease. Right? With regard to two parties to the lease, lessor and lessee. I think I have a table. Yes, this will explain it much better. All is here. I won't miss anything. Now, this is the new standard as per the US GAAP for leasing. Let us discuss this first, then we'll go back to the question number 2. If any of the 5 criteria, initially there were 4 criteria in the US GAAP. Now they have added an additional criteria. If any of these criteria is met, if any of the 5 criteria is met, the lease will be classified as a finance lease. Right? For lessee, it's finance lease. For lessor, it's called the sale type lease. Remember, finance lease is a term now used for lessee, and sale type lease is a term used for lessor. This is something different. Initially, it was finance lease for the lessee as well as for the lessor. But now, when the word finance lease is used, it is used for lessee only, and sale type lease is used for lessor. So, a finance lease will have to meet any of these criteria, any of these 5 criteria. First, if the ownership in the asset is transferred, it's a finance lease. For the lessee, sale type lease for the lessor. If there is an option to purchase, bargain purchase often as per the previous leasing standard. If there is an option to purchase, lessee is reasonably certain to exercise, then it will be a finance lease for lessee, sale type lease for lessor. Third criteria, the lease term. Let's say an asset has an economic life of 10 years. Right? And the lease term is 10 years. 12 years is the asset's economic life. 10 years is the lease term. So if you see, the lease term covers 10 by 12, more than 83%. More than 83% of the life of the asset is covered within the lease term. So if lease term is more than 75% of economic life, in this case it is 83%, it is considered as a finance lease for lessee and sale type lease for lessor. That's the second criteria. Fourth, that's the third criteria. Fourth, present value of lease payments that the lessee will pay to the lessor plus residual value. If their present value is more than 90% of the fair value of the assets, it will be classified as a finance lease for lessee and sale type lease for lessor. This is the new criteria added in our new leasing standard 2019 effective date. If the asset is of special class, special category, or it's a special asset that will have no alternate use to the lessor, if this criteria is met, then it will be a finance lease for lessee and sale type lease for lessor. So any of these 5 criteria, if met, the lease will be classified as a finance lease, right? When none of the above criteria is met, none of the above 5 criteria is met, then what? Then lease would be operating lease for lessee, right? And operating or direct financing lease by lessor. Direct financing lease only if the criteria 4 is met, this one, and it is probable that the lease payment plus residual value guaranteed by the lessee will be collected by the lessor, right? So going back to our question, this was the question. Crawford Corporation is a lessor. Crawford classifies lease as a sale type lease. Yes. Sale type lease basically is the new classification of finance lease. It is most likely that Crawford is reporting under the US GAAP because this classification is under the US GAAP. If there is any uncertainty regarding the payment, it can't be classified as a sale type lease. If the lessor retains the lease asset on its balance sheet, it cannot be classified as a sale type lease. It is then classified as a operating lease. So this sale type lease is only, this classification is only available in the US GAAP. The lessor classifies all leases either the finance lease, similar to the sales type lease under the US GAAP. This is the IFRS difference, or an operating lease. So finance lease and operating lease is the classification under the IFRS, whereas in the new US GAAP leasing standard, the lease is either classified as a finance lease for lessee and sale type lease for lessor. And if they do not meet the criteria, then they have this other criteria of operating lease and direct financing lease. So that makes C to be the correct option, because sale type lease classification is only available in the US GAAP. C. Right, next. Under the US GAAP, lessee must recognize balance sheet liability for what? Now, this is something new which wasn't there in the previous leasing standard. I'm sure you people remember. Let us consider, look in the past. What we used to do in the past, what we will do now. Previously, the lease classification was capital lease under the US GAAP. Now they call it finance lease. Previously, it was capital lease and operating lease. Under the capital lease, lessee used to debit the asset, under the lease, credit the liability. And under the capital lease, the lessor used to remove the asset from his book by crediting the asset and debiting the receivable under the lease, right? And in operating lease, lessee was just paying the rentals. Lessee was just paying rent. He used to debit rent, credit bank. That was the previous standard. I'm just giving you a comparative analysis. And lessor used to consider it as his normal asset. He used to charge depreciation. He used to upkeep the asset. That was the old standard. Under the new standard, whether the lease is, now the capital classification is gone. We no longer use the word capital in the US GAAP. We use the word finance. Please remember, now we use the word finance. Finance lease and sale type lease. Finance lease, the word is used for lessee, and sale type lease is the classification used for lessor, right? So under the US GAAP, lessee must recognize balance sheet liability for, now whether under the lease, if it's a finance lease or an operating lease. This is something interesting and new. Whether it's a finance lease meeting those 5 criteria, or it doesn't meet any of the criteria, whether the lease is finance lease or an operating lease, lessee will have to debit the asset, but the new word used is not the asset. They call it right of use asset. This is the exact terminology used in the US GAAP. Right of use asset, not the asset. Right of use asset debit, and credit is lease liability. This is the same entry we pass in finance lease and the same entry we pass in the operating lease. This was not the case previously. So right of use asset, this is the exact terminology used in the standard. Right of use asset, debit, and liability credit. So interesting point to remember, for the lessee, whether the lease is a finance lease or an operating lease, Entry is the same. Debit the right of use asset, credit liability. Debit the right of use asset, credit liability. It's just that the right of use asset is treated differently in operating and finance lease, but the original entry to recognize the asset and liability is the same. So remember, general rule for finance and operating leases, a lessee must recognize a lease liability and a right of use asset at the lease commencement. So it means whether it's a finance lease or an operating lease, asset and liability will be recognized. This is something new which wasn't there in our previous leasing standard, right? And that's we have already discussed. All right, here we go. Next question is bond valuation. A bond is issued at the end of year 2000 XO with 8% semi-annual coupon rate. Semi-annual means paid twice a year. It's an important point. 5 years to maturity, okay, and a par value of $1,000. That means the redemption value. The bond yields at an issuance is 10%. This is the bond yield or the effective rate. Using the effective interest rate method, if the yield has decreased to 9% at the end of year 2000X1, the balance sheet liability for the bond is closest to. We have already done it in our CMA Part 1, or CMA Part 2, Corporate Finance Bond Valuation. The value of the bond, the price of the bond is simply what the price of the bond would be, the value of the bond. It is the present value of principal plus present value of interest. But in CMA, we used to take a longer route. But now, since we are doing CFA, we have a much quicker way of doing things using our financial calculator. We'll use our financial calculator and I'll show you how to put the numbers and we can directly calculate the present value of the principal and interest, and we can calculate the current value of the bond. Remember, this is what we know for the basic. Remember, interest is paid as per the coupon rate. Interest payment, please note this down. Interest payment, it is calculated by multiplying your coupon rate with the par value of the bond. This is called the interest payment. Coupon rate multiplied by the par value of the bond. Then what is the interest expense? Interest expense is calculated by seeing how much interest we have paid plus minus amortization of bond discount or amortization of bond premium. We will discuss as we move along, right? Because sometimes our bond, $1,000 bond sells for more than $1,000. That is called the issued at premium. And sometimes our bond will sell for less than. Why will it sell for more? When your offered rate is more than the market rate or yield rate, the bond will sell at a premium. Your offered or coupon rate is lower than the market or the effective rate, then the bond will sell at a discount. Clearly, we will discuss as we move along. Remember, for the present value computations, you must always discount the principal, you must always discount the interest payments at the original effective rate when the bond was issued. That's an important point. Remember, interest is paid at the coupon multiplied by the par, that you know how to calculate the par value multiplied by the coupon, simple. But the discounting is done at the rate that was prevalent at the issue date, and that rate is not the par, it's the effective rate or the yield. Even he has given us that the yield has fallen to 9, even it might fall to 3%, I don't care. For discounting, the yield rate is used that was prevalent at the issue date, not when the balance sheet date is being observed. So we have to consider the rate used at the inception or at the start when the bonds were issued. Now we have to calculate the value of the bond to be reported on the balance sheet. For this we need to identify some numbers. Let's do that. First, the bond maturity is 5 years. We issued at the end of 2000XO. Right now it's the end of year 2000X1. It means 1 year has gone. Remaining life of the bond is 4 years. Since interest payments are made semi-annually, that means the number of periods involved, 2 periods every year for 4 years, the periods would be 8. N is 8. Mind the word, the number of periods is 8. Next is what you call the interest rate, I upon Y, used in the financial calculator. We won't use 10% because this is for the whole year. Remember, discounting is done at the original effective rate, the rate prevalent when the bonds were issued. So we will take 10% since it's being considered semi-annually, so you will have to divide 10% by 2. That's 5%. Right? What is the interest payment? Called PMT in the financial calculator. Interest is paid at the coupon 8% multiplied by the original par 1000, that is 80. Since semi-annual coupon, so this 80 will be split in two parts. 40 will be paid first 6 months and 40 after the next 6 months. So it means the payment is 40. When the bond will be redeemed after 4 years, the future value which we have to pay, the redemption value, is $1,000. You need these 4 things. You need the number of payments or periods. You need the interest rate at which we need to discount. We need the regular interest payment that you make. And we need the future redemption value, of course, the par value of the bond. You need these 4 elements to calculate the present value. How do we do that? Let me show you. First, you need to enter the number of periods. So for this, you will press 8, and this is representing the number of periods, n. So n is 8, right? This is the first element you entered. Then the interest rate is 5%. You will write 5, and then you need to press this button. Next, the payment, the interest payments, 40. And then you need to press this button, PMT. And then you need to press $1,000. And then you need to press FV, the future value. All values have been entered. You have entered the periods, you have entered the interest, you have entered the interest payments, you have entered the future value. What you need to do, just need to press this CPT, that compute. We need to calculate the present value. It's negative 935.36. This is the present value of the bond, or the value you will show on your balance sheet, right? So remember, when your payment is positive, your future value is positive, your present value will be negative. When you use negative with PMT, you use negative with future value, your present value will be positive. So remember, if it's plus plus, you will get a negative here. And if you write negative here, because it's an outflow, PMT, and negative 1000, so you will get a positive. So remember, either you use plus plus these, you get a negative, or you use negative for both, and then you get a positive present value. So the result is C, and C it should be. Next, a firm issues a 5 million zero coupon bond with the maturity of 4 years when the market rates are 8%. Remember, it's a zero coupon bond, means the PMT would be 0, right? 8% is the market rate. This will be used for discounting purposes. Assume semi-annual compounding. What is the firm's initial liability? The present value of the bond at the start of the bond issue, and the value of liability in 6 months. So we will do the same thing. We will have to determine some basics, and then like N, we need to calculate interest, payments, and future value. Then you'll simply plug in the values in our financial calculator and get our answer. Okay. So let's write down the numbers. First, what we have is the future value given. Future value is 5 million. You can write negative now in this. With these numbers, you will get the positive present value. Let's try this way, negative. Okay. What about the payment now? Since it's a zero coupon bond, there is no payment. Payment is 0, and you must enter this 0. You must enter 0. You must enter 0. Otherwise, you will get a wrong answer. Okay. Since the payment is made on semi-annual basis, compounding on semi-annual basis, means then the 4-year bonds will have 8 periods. So N is 8. Right. N is 8. Payment is 0. What about the interest rate? Since payments have been doubled for 4 years, because there's 8 semi-annual periods, so you must divide the interest with 2 as well, so as to give you IY to be 4%. Right. You have what you needed. You have future value, that is the par at redemption. You have the interest payments, you have the number of periods, and you have the interest rate. Just you need to plug in the numbers and you'll get your answer. So 5. Alright, so starting first with the number of periods, 8. You can start anywhere. Interest rate 4%. PMT 0. And future value is 5 million negative. Right? And you must press FV. So we have entered all these 4 variables and it will directly calculate the present value of the bond for us. We simply need to press CPT and then present value. See, it is 3653451. 3653451. This is the initial liability at which you will book the bond. So this is the initial amount at which the liability will be booked. So let us consider this to be our correct option because this is the only option that carries the correct number. Then of course you can click and move on, but we need to calculate the liability after 6 months. How do we calculate liability after? This is the original value at which we have booked our liability, right? That's the book value. What will be the value of this liability after 6 months? Remember, our effective interest rate we'll be using is 4% because being compounded semi-annually. So simply what you will do, 3.653451 multiplied by 4%. Whatever the result comes is your liability to be added in the bond. 3653451 multiplied by 4%. It is 138.04. So this is the initial liability and this is the interest accrued. So the total liability, this plus the amount I calculated, just add these two, 363,451. What you get? 146,138 plus 365,3,451. It is 379,9,598. That's a perfect match, and that makes option A to be your correct option. Right? Initial liability plus the accrued interest together, the total liability becomes 379,9,589. Right? Doesn't mean that we will report bond at this value. It's just that this is the bond's book value plus accrued interest combined gives you the total liability this way. Please keep this thing in a very clear way on your head. Okay, moving on. Under IFRS, a lessor retains the lease asset on the balance sheet when? Remember IFRS. Under IFRS, if it's an operating lease, lessor will report it as his own asset. Remember, operating lease for the lessor means the lessor retains the property or the asset under his control. He will report it on the balance sheet. He will charge depreciation expense on the asset. Remember, so under IFRS, under operating lease, lessor retains the control of the asset. He books the asset as his own on the balance sheet, charges depreciation accordingly. But under finance lease, under IFRS, the lessor removes that property from his book. So under IFRS, the lessor retains the lease asset on its balance sheet. Under what? Under operating leases, yes. But under finance lease, he will have to get rid of the asset from his books because under finance lease, it is assumed that the control has shifted from lessor to the lessee. So that makes C to be the correct option. Now we know the reason. Next. Larry Purcell, an entity level fixed income analyst at Knowlton Schmidls LLC, was discussing debt covenants. What are debt covenants? Debt covenants are restrictive clauses, restrictions put on the issuer so that the interest of the bondholders could be protected. So debt covenants are restrictive clauses put on the issuer so that the interest of the bondholders could not be put in danger. Right? So we are discussing some debt covenants with the supervisor, and the name of supervisor Andy Holzman. During the meeting, Purcell made the following statements regarding bond covenants, restrictive clauses related to bonds to put the issuer under an obligation not to do anything that might jeopardize the interests of the bond holders. So we have two statements. Which of these statements is correct, or both are correct, or both are incorrect? Let's read them one by one. If a firm violates any of its debt covenants, the company will immediately go into bankruptcy and the creditors of the firm will take over the liquidation flat. This is ridiculous. It doesn't make sense. If a company defaults or any of the debt covenants, it's not that the company goes into liquidation and assets are taken over by the creditors. It's just that company has violated a debt covenant. This violation can either be renegotiated with the bondholders, or there might be certain penalty, or maybe then the bondholders can take the issue to the court of law. It's not that any covenant is violated and the company goes into bankruptcy. This is wrong. This is not right. Otherwise, you would have seen many companies going bust. So this is not a correct statement. Statement 2. Debt covenants are important in evaluating a firm's credit risk. Yes. And to better understand how the restrictions put by these covenants can affect the firm's growth prospects and choice of accounting policies. Yes. When the restrictions, like for example, in a debt covenant or bond covenant, restriction could be put that the company's current ratio will not fall below 2:1, or company will not pay more than 10% dividend to the common stockholders. Any such restriction could be put so as to protect the interest of the bondholders, right? So this condition, these restrictive covenants will help the company's analyst to evaluate the credit risk and better understand how these restrictions can affect the firm's growth prospects and choice of accounting policy. So that makes only one of these statements is correct. This one is correct, but this one is wrong. So you can say that only one of these is correct. So remember, a restrictive covenant doesn't mean that the company goes into liquidation. If the bond covenant is violated, go for renegotiation. It's not a risk. It's a technical default, but not an actual default where the company will be wound up, right? Terms can always be renegotiated. C is the right answer. Moving on. In analyzing disclosures related to financing liabilities of a company, which of the following disclosures would be least helpful to the analyst? Least helpful, mind the word. The present value of the future bond payments discounted at the coupon rate of the bond. First of all, discounting is done, but we do not use the coupon rate. Remember, discounting is done. I just told you. Discounting of principal and interest is done at the effective rate that was prevalent at the date of the issue of the bond. Coupon rate is not used for discounting. First of all, this is wrong. And even if it is discounted, we don't, an analyst is not interested. This is not one of the disclosures that what is the present value of the future payments, right? Disclosures means something given outside the balance sheet. Rest of it are prepared under the US GAAP and IFRS. Notes, further supplementary information, schedules. So what we need to show, the interest expense for the period is provided on the income statement or in footnotes. Interest expense and interest paid, they are different. Interest expense is charged on the book value of the bond multiplied by the effective rate. Remember, interest expense is equal to book value of the bond multiplied by the effective rate that is used in discounting. And interest paid, this is very critical. Most of the students make mistake. Interest payment is equal to par value of the bond multiplied by the coupon rate. Interest expense, it's equal to the book value of the bond multiplied by the effective rate that was prevalent at the date when the bonds were issued. Keep that in mind. Sometimes interest payment could be more than expense. Sometimes expense can be more than payment. When? We will see that. So this is an important disclosure. Filings with the Security Exchange Commission, filings with the Security Exchange Commission that disclose all outstanding securities and their features. Yes, the features of securities that have been issued, that they must be disclosed as well. So B and C, these are required, but this is not the one. And moreover, the statement is incorrect. We do not discount at the coupon, rather we discount at the effective rate that was prevalent. So A is the right answer. Next, question number 9. When the market rate is greater than the coupon rate. Now just gentlemen, we need some good time on this question. I will try to explain many things with the help of this question. Whenever the market rate is more than the rate you are offering at the inception of the bond, let's say the market rate is 10% and you are offering just 6% to your bondholders. The rate is less. Your bond will sell at a discount. It is called a discount bond. Whenever your coupon rate is less than the market rate, the bond will sell at less than par. It's called a discount bond. In this case, remember, since it's a discounted bond, your interest expense will gradually increase. Interest expense will be more than the interest payment, because interest is paid at 6%, interest is charged at 10%, right? Next, let's say if your coupon rate is more than the market rate, your coupon rate is greater than the market rate, you are offering 12%, whereas the market rate is 10%. Since your rate is so good, people will be willing to pay more price than the par of the bond. This is called a premium bond. In this case, your interest expense, we will do the computations later, would be less than the interest payment. And very rarely, but still possible, your coupon rate is equal to the market rate. If the market rate is 10%, you have offered the bond at 10%. In this case, the bond issued at par is called a par bond. And in this case, your interest expense and your interest payment, they are the same. Since the market rate is greater than the coupon rate, the bond is called a discount bond. So right now that makes C to be the correct option, and C it is. Right, moving on. Other things equal and ignoring issuance cost. A firm that raises cash by issuing new bonds is most likely to what? First of all, when you issue bonds, how does it affect your leverage and your coverage ratio? First of all, we know leverage and we know coverage both. Leverage means debt upon equity, and coverage means earning before interest and tax upon interest. So when a company issues bonds, your debt goes up compared to equity, so the leverage goes up. Since bond would result in interest payments or interest expense, your interest expense goes up. Resultantly, the coverage falls. So issuing bond would increase leverage, reduce coverage. Let's see. Decrease the leverage? No. Leverage goes up? Wrong. And increase the coverage ratio? No. Coverage falls. A is incorrect. Let's see B. Increase its leverage? Yes. You can see. Decrease its coverage ratio? Yes, that's true. Correct. Without any doubt, we know B is the right answer. Let's see C. Increase its leverage? Wrong. This is the part is correct. Increase its coverage? No. Coverage is falling. So for this reason, C is rejected as well. So B is the right answer. Alright, next. Again, at the date of issuance, the market interest rate was above the coupon rate. When the market rate is more than the coupon rate, what do you expect? Market rate is more than the coupon rate. You are offering less rate to the bondholders. Resultantly, your bond will sell at lower than the par. And such a bond is called a discount bond. And that is what we just studied a little while earlier. Discount bond. Next. Which of the following statements for a bond issued with coupon rate above the market? When the coupon rate is greater than the market rate, it will sell at a premium. We know that. We just learned. So which of these is least accurate? Since your rate offered is more than the market rate, the bond will be shown on the balance sheet at a premium value. Correct. The associated interest expense will be lower than the implied by the coupon rate. Interest expense is calculated on the market rate. Payment is calculated at coupon rate. So you can see associated interest expense calculated on the market rate will be lower than that employed by coupon. Makes perfect sense. Because interest expense, as I just told a little while earlier, is calculated on the market rate, interest expense, whereas the interest payment is calculated at coupon. Since market rate is lower, hence interest expense will be lower than the coupon, so that is correct statement as well. Last, the value of the bond will be amortized towards zero over the life of the bond. No, this is wrong. Bond is not amortized, rather the premium or discount, like for example, if you sell a bond, $100 bond for $115, this is 15 and called bond premium. Sometimes when your offered rate is lower than the market rate, $100 bond for sell for $80, this is called discount. This premium and this discount is amortized over the period. We will see in the later questions. This premium and this discount, this is amortized to zero, not the bond itself. That's the wrong statement. Not the value of the bond, rather, in this case, the premium will be amortized towards zero over the life of the bond. If it's a discounted bond, then the discount will be amortized towards zero over the life of the bond. So that makes C to be the correct option, because we were looking for the one that was least accurate. Next, question 13. The firm is most likely to lease an asset rather than purchase if the asset is costly to move from one place to another. It is better to buy rather than lease. Buy it as your own and don't worry about the moving from one place to another. If it's yours, you don't have to dismantle it. Has a high salvage value relative to cost. Buy the asset. When the life is over, you can sell it at a high price. So in this case, buying is a good decision. But if the asset may be made obsolete by rapid technology advances, it's better to lease, and after a couple of years, khali wali, you can just kick the asset out. In this case, leasing is good. If the asset becomes obsolete rapidly because of technological change, then it's better to lease and then come out of the lease agreement before the lease reaches its maturity, if it's cancelable, right? So that makes C to be the correct option. Moving on. It's a good question. Company issues an annual pay bond. The interest is paid annually with the following characteristics. Face value, that is the value, par value at which we pay the interest. Remember, this is a good question. Many things will be discussed. Amortization of bond discount or premium, whatever is involved, will be discussed in this question. This is the par value or the face value at which the interest is paid. This is FV. Maturity, I'm going to take it N because there is no semi-annual or monthly payments. N is 4. Remember. Discounting is done at market rate. Coupon has nothing to do. Coupon is only used for interest payments. Coupon is only used for interest payment. Discounting is done at 8. This is what you will take as interest rate. Right? Now, what do we need now? We have the par at which interest is paid. We have the maturity. We have the effective interest rate, market rate. We need to calculate the payment. What payment? PMT. How do we calculate PMT? PMT is the interest payment, and that's very simple to calculate. I told you interest payment paid is calculated on the par multiplied by the coupon. Coupon is used for interest payment. Discounting is done at the market interest rate. This is something people repeatedly make mistake, and I hope you won't. 67831 times 7% means 4748.17. This is your yearly interest payment. So we have these 4 variables. Using this, we can calculate our present value. Why are we doing all this? We need to find what is the unamortized discount at the end. We can't calculate amortization or unamortization unless we know what was the present value of the bond at which it was issued. And then I will explain what is amortization of discount and what is discount itself. Everything is coming your way in a minute. Alright, so in any order, you can start PMT first. The payment is 4748.17. You can omit points if you want to. This is PMT. I've just put 0.7. Let's not make a mistake because value might be different. Let's write it again. 4748.17. This is your PMT, right? Next is the future value, the par of the bond. That is 67831. 67831. That's FV. Then N, that is 4. Then we have the interest rate, that is 8%, 8. Now, when I will press CPT and present value, it will give me the present value of the bond at which we book the liability. It is 65584. let me write it down. It is present value. It is 65584. Now, gentlemen, listen to me very, very, very carefully. This is the par of the bond, and this is what we received from people. The par value was 67,831. We received less, 65,584. Why? You know the reason. You are offering just 7% interest rate, whereas the market rates are 8%. Since your offered rate is lower, market rate is higher, so your bond, a $67,831,000 par value bond, is selling for less. And this less amount, the difference between the par value and the value you received, is called the discount. What is this discount? 67,831 less 65,584. It gives you 2247. This 2247, remember gentlemen, is called the discount on bond issue. This 2247 will be amortized over the period of the life of the bond. How do we do that? That's the point. 2247 is the discount. Now we will calculate two things. We will calculate the interest paid and interest expense. How do we calculate interest paid? Interest paid is calculated on face value 67831 multiplied by the coupon. This is the interest payment. 67831 multiplied by 7%, that is 4748. 4748 for the first year. What is interest expense? Remember, interest expense is calculated at the book value, which is 65,584 multiplied by the effective rate 8%. So 65,584 multiplied by 8%, it's 5246, approximately 5247. This is what you have paid, par multiplied by coupon. This is the expense, book value multiplied by the effective rate. The difference between the payment and the expense for the first year is the reduction in the discount called the bond discount amortization. The difference between these two is 4748 less 5247. It's 499. It means out of this 499, 2247, the total discount on the bond, 499 has been amortized over the period, right? So what we need to do, we need to give him the unamortized discount at the end of the first year. This is the total discount out of which this has been amortized. What does amortize mean? Means this 499 will be added right here, 65584. Next year, the amount will be added again to whatever the balance comes. This way, the present value will keep on going up, 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 and by the time the bond matures, the book value will exactly be equal to the face value. Remember, so this is the way discount amortization, every time, every year, the amortized amount, the amortization difference is added to the present value of the bond. It keeps on going up. At the maturity rate, your par value and your bond book value will be the same. Same is true for premium. In case of premium, you will find a bigger amount here, maybe 75. This 75 will reduce every year by premium amortization, 73, 70, 69, 68, and by the fifth year or fourth year, your par value and your book value, the bond will come equal. So that's the point to remember, that premium and discount are amortized every year, and at the date of maturity, the par value and the book value of the bonds, they become equal. So this is the original balance on discount, and this much has been amortized. We need the unamortized discount. This was the original discount out of which this much has been amortized during the current year. So 2247 less 499 should give you somewhat close result. 2247 less 499, it's 1748. Because of rounding off, B is the right answer. B it is. Right, next. Interest expense is reported on the income statement as a function of what? What we have just seen. This is your interest expense. Interest expense is the book value multiplied by the market rate, right? So interest expense is a function of market rate. Market rate multiplied by the book value of the bond. Market rate. So we don't need to look any further. Market rate multiplied by the book value of the bond. The coupon payment is simply the coupon rate multiplied by the par. It has nothing to do with income statement expense. This is the interest paid. This is the payment. Interest payment is the coupon rate multiplied by the par. Unamortized bond discount rate has nothing to do with the payment or with the income statement expense. It is reported as a part of balance sheet item. So it's market interest rate. Next, for a long-term lease, the amount recorded initially by the lessee as a liability will most likely be equal to what? I'm sure you people still remember. The liability is recorded at the present value of minimum lease obligations. The little change that has been brought about in 2019, instead of debiting the asset, we debit the right of use asset. Right of use asset is debited and liability under the lease is credited. And what is the amount with which we debit and credit? The present value of minimum lease payment. This is the same as for the previous leasing standard we have discussed. A is the right answer. Next, which of the following is least likely to be disclosed in the financial statements of a bond issuer? Least likely. Collateral pledged as a security in the event of default. This is very essential, must be disclosed. Bonds have been collateralized, so which specific asset has been offered as a security? Must be disclosed. Must be disclosed. Then, the market rate of interest on the balance sheet date. This is not requires any, doesn't require any disclosure. Market rate on the balance sheet, it is not disclosed. It's known to everyone. It is not something that a company would try to hide. The amount of debt that matures in each of the next 5 years, that's specifically required. Collateral pledged must be disclosed in the notes to accounts. What is the asset, which property has been used as a collateral must be disclosed. And you must also disclose the amount of any principal that is to be repaid in the coming 5 years for various bonds. Bond A, Bond B, Bond C. So what are the next 5 years payments of principal needed for ABC? That requires disclosure, but this is not. So most of the question will only require some common sense and you will get it right. So B is not one of those requirements. So that makes B to be the correct option. Next. The primary purpose of bond covenants. Bond covenants are the restrictive clauses in the bond that protects the interest of the bondholders. So what is the primary purpose? Why do we do that? Clearly define the responsibility of the borrower and the lender. What is the responsibility of the borrower, company, and the lender that is provided? Responsibilities, terms, they are expressed in the funds, and we need to protect them against any decision that can put their interest in danger. C. Next, this is the one that will express many ideas. Over time, the reported amount of annual interest expense on a long-term bond issued at a discount will, let's say we have issued a bond, just an example, a $1,000 bond at 800. Why will you do that? It's because your coupon rate is less than the market rate. Your bond will sell at a discount. So this 200 difference, the difference between, this please gentlemen, I need full attention. I need full attention because that's where people get trouble. The difference between the par and the book value is called discount in this case. Let me see what was the exact number, 28.2. I want to make sure that I get the right 32.08 and 34.21. That's about 124. So the bond par basically was 924.57. That was the par of the bond, but it was sold for 800. The difference between these is 124.57. This is the discount on bond issue, which will be amortized over the period. Gentlemen, attention. Coupon is same. Why? Because coupon rate is the same and the par is the same. Par by coupon 25, 25, 25, 25. Right? But remember, interest expense is calculated by multiplying the book value with the effective rate. As you can see, the interest expense is 53. Why? Book value multiplied by the higher market rate. The difference between the interest expense and interest paid is called the discount amortized. This discount amortized 28.2. It will be added to the book value of the bond. Next year, interest is paid 25, but interest is charged at this base 8 to 8.2 multiplied by the whatever the market rate 55. The difference between what we paid 25 versus what we charged, this difference is called the discount amortization. This amortized discount will go again to this. So we keep on adding this amortized discount in the book value. By the time the date the bond matures, the par value and the book value, they become same. And this is the total bond discount 1 to 4.57, which has been amortized over the period of 4 years, right? So that's how amortization is done. Amortization, whether it's a premium or it's discount, it will bring the book value and the par value of the bond equal at the maturity date. So what we need to find out in this is that over time period, the reported amount of annual interest expense on long-term bond issued at a discount will increase. Why is it increasing? Because book value is increasing. Book value multiplied by the market rate. Market rate is fixed. Since the book value is increasing every year, that's why your interest expense is increasing every year. It increases. B it is. Next, now we need some serious calculations again. And why have we put it here? On December 31st, 2004, on December 31st, 2004, Newburgh Incorporated issued $1,000 face value 7% bonds to yield 6%. Now, some important information we must extract right now. First of all, there are 5,000 bonds. Each with par of 1,000. It means the total amount involved is 5 million. 5,000 times 1,000. So the total amount, the face value is 5 million. Par value, future value, 5 million. 7% bonds, this is coupon rate. To yield 6% rate, this is the rate we will use for discounting. Now remember, your coupon rate is more than the what you can see right here, than the market rate. Now your bond will sell at a good price. You will sell the bond for more than 5 million. Why? Because your coupon rate is more than the effective rate or the market rate. Further, the bond pays interest semi-annually and are due on 31st of December 2011. That's 31st of December 2004, 5, 6, 7, 8, 9, 10, 11. It's a 7 years bond. Right. Now, what are the important pieces of information? First of all, it's a semi-annual payment, so the number of periods would be 7 times 2, 14. Right. What's the future value is given? FV, or the face value, the par value. There are many names, whatever name you want. $5 million. Remember, the interest we use for discounting purpose, it is not the coupon rate, it's the market rate. Since we are talking about semi-annual payments, you need to divide it with 2, so it's 3%. One thing is missing, PMT, the annual interest payment or the semi-annual interest payment we make. This is the face value of the bond. Multiply it with the, remember the interest is paid at coupon rate multiplied by 7%. Right? So what's the single payment? 5 million multiplied by 7% multiplied by 6 upon 12 or 1 over 2, whichever you want to do. So it's 5 million times 7% multiplied by 6 by 12, 175. This is the payment you make, $175,000. What do we need now? We need the present value. For this, we need our calculator. We need to plug in the numbers first. N, 14, Next, face value, future value redemption, 5 million. Done. Interest rate 3. Payment that you make every year. I'm taking this time plus. I'll get a negative NPV. So 175. Right. Now I will simply compute. I'll press CPT and present value CPT. It is 5282402 rounded off. This is the number I need to start with. This is the present value, and this is I will use to populate my data here in the discount amortization. So what basically, it's not discount, sorry, I just said discount. Since your offered rate is 7%, market rate is 6%. Look at what has happened. This is the face value of the bond, and look at what you are receiving right now, 5282402. You have received more than the par value of the bond, more than the face value of the bond. Why? Because your rate 7% is higher than the market rate, 6%. So that's the point to remember. This is year period 0. Right now the bond value in the book is 5282402. When first period of 6 months is over, period 1, what exactly do we need? We need to find out the interest expense for the period, for the whole year. On its December 31st, 2005 income statement, the interest expense to be calculated. Now, remember, this is the original present value of the bond that we have calculated, 5282402. Now, interest expense is charged at the bond present value multiplied by the market rate that is given here, 6%. So remember, interest expense is equal to bonds book value multiplied by the market rate. And coupon is always the same. It's 175, 175, 175 every time. It's the twist with interest expense. So the interest expense for the first period will be, you'll take this amount, 5282402, you'll multiply this 5282402, that's the book value, multiply this with 6% and divide it with 2, or simply multiply it with 3%. It gives you 158,472. This is the interest expense for the first period. It's not first year. It's the interest expense for the first 6 months. 158,472.06. The difference between the interest expense and the coupon is called the premium amortization. This is the premium now because your present value is more than the face value. So 158,472 less 175, you get 16,528. This will be amortized. We need to bring this bond value back to 5 million after 7 years. So it will start reducing from right now. Add this 5282402. This is a negative number. Added to this gives us 5265874. See? What will happen in the next 6 months period? We will pay interest on this. We will pay 175 interest, but interest expense will be charged on the book value. 5265874 multiplied by 3%. Now it's 157,976. The difference between what you paid versus what was the interest charge in the income statement is called the premium amortization, less 175. This is 17,000. It's a negative number in my calculator. And we charge this negative number against this, 526,5874. It falls to 524, see, 524,8850. So this bond value or book value will keep on falling. By the time 7 years are over, your book value will be exactly equal to the face value of the bond, right? So what we need exactly, we need to calculate the interest expense. This is the interest expense. This is the interest paid, 350. And interest expense is 158,472.06 plus 157,976. That gives you 316,448, and that's exactly your option B. Next question. At the beginning of 2003, Creston Company issues 10 million face value or face amount of 6% coupon bond when the market interest rate is 7%. So this is the coupon, this is the market rate. The bond matures in 4 years and pay interest annually. Assuming effective interest rate method, what is the bond liability Kristen will report at the end of 2003? Means 1 year is gone, so the remaining period to maturity is 3. Interest rate effective for the purpose of discounting 7%. Coupon payments at the rate of 6% of total amount 10 million. So it's going to be PMT is equal to $600,000, and the future value, the face value of the bond is 10 million. All you need to do is just enter these in the TVM computations on your financial calculator and press CPT present value, and if you do so, you will get 9737568, and it will perfectly match with option C. Next, for a firm financed with common stock and long-term fixed rate debt, an analyst should most appropriately adjust which of the following items for change in the market interest rates. Interest paid is not adjusted because it is paid on par. Interest is paid coupon rate into par. It has nothing to do with the market price. Debt to equity ratio, yes. If the interest rate goes up and down, it affects the value of the debt. The market price of the debt changes accordingly, and it will affect your debt to equity ratio. Since the value of the debt changes, the market value, so it will change your debt to equity ratio. This is true. So that is the right answer. Next, a firm is more solvent if it has two ratios are involved: leverage and coverage. Leverage and coverage. The lower the better, the higher the better. That's debt upon. So I don't need to write the formula. We'll go. The leverage ratio should be lower, the better. More solvent firm will have lower leverage and higher coverage ratio. So we don't need to do any computation. No need of formula. Low leverage and high coverage ratio. That makes B to be the correct option. Next, assuming all else equal, if the coupon rate offered on a bond is less than the corresponding market rate of the interest, the bond will be issued. Okay, now here we go. Remember, if the market rate is greater than the coupon rate, it means you are offering less rate, so the bond will sell at a discount. It's called a discounted bond. And resultantly, in this case, your interest expense will be greater than the interest paid. If the market rate is less than the coupon rate, your coupon rate is higher than the market, your bond will sell at a premium. In this case, your interest expense would be less than the interest paid. And very unlikely, but if it is market rate is equal to coupon rate, in this case, the bond will sell at par and your interest expense will be equal to your interest payment. So, assuming all is equal, if the coupon rate offered on the bond is less than the corresponding market rate, the bond is issued at a discount. That makes A to be the correct option. On December 31st, 2003, OK Company issued 100,000 face value of 10 years 9% bonds to yield 7%. These many bonds of this par value, this is the duration, I mean the period of the bond maturity, this is the coupon, and this is the market rate. The bond pays interest semi-annually on its financial statement prepared under the US GAAP for the year ended December 31st, 2004. The effect of this bond on OK's cash flow from operations. So remember, under US GAAP, interest payment is considered as an operating outflow. So 10,000 bonds, each of $1,000 each, means the total par of the bond is 10 million. Interest is paid at coupon. So 9% of 10 million, that gives you $900,000. This will be considered as an operating outflow. That makes A to be the correct option. Under IFRS, when lessee recognizes a balance sheet asset and liability for a new lease, they are neither greater or lesser. The asset and liability are equal. So that is a straightforward question C. The difference between the fair value of a defined benefit pension plan's assets and its estimated benefit obligation is recognized as what? First of all, if the fair value of pension assets is greater than the estimated benefit obligation, the net is called the net pension assets. Right? In this case, it is said to be overfunded. A plan with net pension assets is said to be overfunded. Conversely speaking, if the estimated benefit obligation is greater than the pension assets, in this case, it's net pension liability. So we can say a plan with a net pension liability is said to be underfunded. So it is either net pension asset or a liability, this. So that makes A to be the correct option. A firm can recognize a gain or loss on a de-recognition of a bond the firm has issued before maturity, but not at maturity, but not at maturity. Now let us have the proper idea what it's all about. Remember, if a firm redeems a bond before maturity at a price that is different than the carrying value of the bond, then the firm may recognize a gain and loss. The difference between the carrying value and the redemption value. So it will happen before maturity, but not at maturity. Why? Because at maturity the carrying value or the book value of the bond is equal to the face value of the bond. So therefore the firm does not experience a gain and loss. So it's before maturity, yes, but not at maturity, because at maturity the redemption value is the same as the face value. So that makes A to be the correct option. Next, which of the following provisions would least likely be included in the bond covenants? The borrower must maintain a debt to equity ratio of no less than 2:1. Not less than 2:1, wrong. Debt to equity ratio should not be more than 2:1, because the higher the number, it's not good for the bondholders. So it should be no more than 2:1. You need to set the bar at 2:1. The number should not be more than 2:1. So it should either be less than or equal to 2:1, not more. This is least likely. So maintain an insurance on the collateral that secures the bond. Yes, that is good. That will provide comfort to the bondholders. Not increase dividends to common shareholders while the bonds are outstanding. Yes. So these B and C, they will provide protection to the bondholders, but this is not likely to be. We need debt to equity ratio not more than 2:1. Right? So this is inaccurate. So that makes A to be the correct option. Next, a company issues 5% semi-annual coupon 3-year $1,000 par value bonds on January 1st. This is the bond maturity, 3 years, coupon, par value, issuance date, when the market interest rate was 13.3%. So your offer date is lower than the market rate, so it will sell at a discount. The sale proceeds are $800, of course, expected. Under the effective interest rate method, what amount of interest expense per $1,000 par value will the company record for the year ending December 31st, 2000X1? So this is right here, we issued the bond at $800, period 1, 2, 3, 4, because in 2 years period starting from 1st of Jan to next 0 to 31st December to next 1, there will be 4 periodic payments or semi-annual coupon payments. Okay, so what's going to be the interest? 5 upon 2, 2.5% of 1,000. So the interest payments would be 25, 25, 25, 25. Now what would the interest expense be? 13.3% upon 2, it is 6.65%. 6.65% of the bond's carrying value, it will give you 53.20. Interest paid was 25, interest expense 53.25. The difference between these is the bond discount amortization, 28.20. Now, what will be the bond carrying value now? Carrying value at the start plus the discount amortized is going to be 828.20. Now, what would be the interest expense next year? 6.65 times 828.20, it will give you 55.20. 32.08. The difference between the interest expense and coupon would represent the discount amortization, 30.08. Now the value of the bond, book value, it will go up to 858.28. Likewise, the interest expense in the third period will be 57.08. The difference between these two would be the discount amortization. It's going to be 32.08. The carrying value will be 890.36. We need the value at the end of year period 4. So the interest expense here would be 59.21. The difference between the interest expense and payment is the discount amortization, 34.21, and then the carrying value of the bond will be 924.57. What is the requirement of the question? What amount of interest expense per 1000 will the company record for the year ending December 31st, next one, these two. 57.08 plus 59.21, and their addition will give you 116.29. That's A. Next, which of the following statements regarding zero coupon bonds is most accurate? The interest expense in each period is found by applying the discount rate to the book value of the debt at the end of the period. No, the book value of the bond at the opening value, like these. Wrong. This is wrong. B. A company should initially record zero coupon bonds at their discounted present value. It's true. It's perfectly correct. Interest expense is a combination of operating and financing cash flows. Wrong. Since it's a zero coupon bond, no cash flow for interest payment because it's a zero coupon bond. So this is an incorrect statement. So that makes B to be the correct option. A debt covenant is most likely to restrict a firm from issuing new common shares. Wrong. If you issue new common shares, you will have more cash at your disposal. So this will make bondholders happy. So this is fine. This is okay. There's no such restriction. Good. Repurchasing common shares, yes, this will result in reduction in cash, and this could affect the company's interest paying capability. This is bad. This might be restricted. Decreasing its common dividends, yes, decrease in common dividends will leave more cash available for the bondholders for interest payments. So this is good. So B might be restricted, but not A and C, and this is what is most likely to be restricted. B is the right answer. For a lessor that reports under the US GAAP, a lease is classified as an operating lease if it cannot be classified as a sale type lease or a direct financing lease. Exactly, that's what we discussed earlier. So if none of these criteria is met, then a lease is classified as an operating lease, and direct financing lease only if this fourth criteria is met and it is probable that the lease payments plus residual value will be collected. So in this case, it will be designated as an operating lease if none of these criteria is met and it is not a direct financing lease as well. So that makes A to be the correct option. Next, which of the following statement is least accurate? When a bond is issued at discount, the interest expense will increase over time. Okay, we'll just see. Now, this is an example of a discounted bond. So the interest expense keep on increasing every year or every period. So this is a true statement. The interest expense will increase over time for a discounted bond. A is correct. The interest expense will be equal to the coupon payment plus the amortization of discount. Okay, let's see. Yes, interest expense is equal to coupon payments plus discount amortized. Next period, interest expense is equal to coupon payment plus discount amortized. It's a true statement. The interest expense will be equal to the coupon payment plus the amortization of the discount. So it's correct. Then it has to be C then. Cash flow from financing will be increased. Yes, it will be increased when the bond is issued, but it will increase not by the par value of the bond. In fact, at the discounted proceed we receive. So discounted amount, not the par. This is least accurate, and that's why it's our correct option. Upon issuance, cash flow from financing will be increased by the amount of the proceed. Since this is a discounted bond, so what you receive is not par. Next, a company issued a bond with the face value of 67,831, maturity 4 years, 7% annual coupon payments, while the market interest rate is 8%. What is the unamortized discount when the bonds are issued? So unamortized discount would be the difference between the amount of proceeds received versus the face value. So this is face value. Now let us calculate the present value, which will be the discounted price. So face value is 67,831. 4 periods. Interest rate per period is 8%. And the interest payment will be 67,831 multiplied by 7%. It's going to be 4748.17. You just need to calculate the present value, and if you do input all these numbers in your financial calculator, you will get 65,584.35. So the difference between the face value and the amount of proceeds received, this is your unamortized discount, and the difference between these two is 2246.65. That makes B to be your correct option. Next, a company has issued new 3-year bonds at par in each of the last 5 years. On the company's balance sheet, principal due on its bonds will appear as what? Since there are many bonds in issue, some which are becoming due within 1 year, less than 12 months, they will be considered as a current liability, and those for more than 1 year will be considered as a long-term liability. So it's both current and long-term liability. That makes B to be the correct option. Next, a firm is issuing a bond with the following characteristics: face value 10 million, annual coupon 5.6, which means the payment PMT would be $0.56 million. This is your interest payment. Market yield is 6.5, that's interest rate per period, and N is 5. We need to calculate the present value. Ignoring flotation cost at issuance, the bond will increase liability by what? We need to calculate the present value of the bond. So you have all the numbers you need. We have FV to be 10 million. We have PMT to be 0.56 million. We have interest rate per period 6.5, N 5. We just need to calculate the present value, and when you enter all these, what you get is 9.625988 million, which is 9.626 million. Now you will receive this much cash, so your assets will increase, liabilities will increase by this amount, not 10 million, and cash flow from investing, not investing rather, it's cash flow from financing activities. So A is the correct option. All right, next question. Assume a city issues 5 million semi-annual pay bonds to build a new arena. The bond has a coupon rate of 8% and will mature in 10 years. When the bond is issued, its yield to maturity was 9%. Interest expense in the second semi-annual period. Interest expense in the second semi-annual period. Okay. Now what do we have? Fair value of the bond is 5 million. PMT, the interest payment, since it's a semi-annual one. So if you calculate the interest payment, 8 by 2, 4%. 4% times 5 million, that is 0.2 million. Right? Periods, 10-year bond, since it's a semi-annual one, so it's 10 times 2, 20 periods. Interest, effective interest per period is 9% per annum, 4.5 per period. Right. Now entering all these in your financial calculator, FV, PMT, and interest per period, you will calculate your present value, which is 4,674,801.589. Okay. Now, what will be the interest expense at the end of the first period? That's the first period of 6 months. So multiply this with 4.5. What you get? You get 210,366. This is the interest expense. What's the interest payment? 0.2. That is $200,000. So the difference between the interest expense and the interest paid, this difference is your bond discount amortized, that is 10,366. Now, what will be the new carrying value of the bond? This was the original value, 4,674,801. This is the bond discount amortized. This amount will be added to the carrying value of the bond. So adding these two will give you 4,685,168. Right. Now for the next period, the interest expense would be interest expense 4.5% of this, since we need the interest in the second semi-annual payment. So it's going to be 4,685,168 times 4.5%, and it'll give you 210,833. This is the interest expense in the second period, and of course interest paid is $200,000. So the difference between these two, 10,833, this will be the discount amortized in the second period. This is the amortization in the first period, second period. It's not needed. We just needed to calculate the interest expense. That's 210,830 approximately. That makes B to be the correct option. Proceeds from the issuance of bond are recorded on the statement of cash flows as an inflow from not investing activities. When you issue bonds, it's a financing activity. Interest payment is an operating outflow, but proceeds of bond issue, it's a financing activity. That makes B to be the correct option. Next question. Compared to issuing a bond at par and holding all else equal, when a company issues a bond at premium, its effects on the debt to equity ratio will be. Since a bond has been issued at a premium, let's say a bond, a $1,000 bond is being sold at $1,050, right? This is your debt upon equity. So when the premium is amortized, this amount in the numerator will fall. Numerator will gradually fall as the premium is amortized, and at the date of maturity, it will be $1,000. So this resulting decrease in the numerator will cause the ratio to fall. Right? So what would be the right option then? An increase in trend in the ratio over the life of the period? No. No effect? No. A decreasing trend in the ratio over the life of the period. Just because the premium amortization will reduce the carrying value of the bond, so that makes C to be the correct option. Next, when bonds are issued at premium, coupon interest paid decreases each period? No, coupon interest is the same. This is a wrong statement. Earnings of firms decrease over the life of the bond as the bond premium is amortized. Now this is incorrect. Why? Because for premium bonds, premium amortized will lower interest expense every period. Since interest expense will fall every period, so income will be higher over the period. So this is incorrect as well. Earnings of the firm increases over the life of the firm as the bond premium is amortized. That makes C to be the correct option. IVO company has 10 million face value bond issued outstanding. These bonds include a call option that permits IVO to redeem the bonds at any time for 101% of par. These bonds were issued at a premium and have a carrying value of 102 million or 10.2 million. This is their carrying value. If IVO calls the bonds, its income statement will reflect. If we redeem the bond, we will have to pay 10.1 million. This is what we pay, and this is the carrying value. So the difference will result in gain, remember. So this would be reported as gain on redemption because a 10.2 million carrying value bond is being redeemed at 10.1. So this is gain on redemption. So that makes B to be the correct option. Next, a firm issues 5 million zero coupon bond with maturity of 4 years when the market rates are 8%, assuming semi-annual compounding periods. The total interest on this bond is. Now, the face value of the bond is 5 million. Periods 4, since it's semi-annual, so it's going to be total of 8 periods. Interest rate per period, effective one is 8%. Since it's semi-annual, so 8% by 2 is going to be 4%. Payment, Mafi interest payment, no interest payment, we just need to calculate the present value. Plug in these numbers in your TVM on financial calculator. You will get the present value. It's going to be 3653451. Now if you compare the par with the amount you received, the difference, since it's a zero coupon bond, so the difference between par and the issue proceeds, this difference effectively represents the interest, the total interest on this bond. So 3653451, the difference between these two will be B, and this was option B, right option. Next, a company issues an annual pay bond with face value of 135,662, maturity of 4 years and 7% coupon, while market interest rate of its bond is 8%. What is the unamortized discount at the end of the first year? Okay, now the face value is 135,662, periods 4, interest payment par multiplied by coupon 7% of 135,662, that gives you 9496.34. Interest per period is 8%. If you plug in all these in your financial calculator, your present value of the bond would be 131,168.70. The difference between the face value and the present value is the discount on bond issue, and these two numbers differ by 4496.34. Okay, now we need to calculate what is the unamortized discount at the end of the first year. Interest expense versus interest paid. This is the interest paid, 9496.34, and interest expense would be the present value multiplied by the effective rate, which we are using for calculating the present value, that's 8%. So 131,168.70 multiplied by 8%, it gives us the interest expense of 10493.496. So the difference between these is the discount amortized, which is 997.156. This is the total discount unamortized, out of which this has been amortized at the end of the first year. So what is the unamortized discount at the end of the first year? Difference between this and this. And if you calculate the difference, it's going to be net 3496,144, which is approximately 3495. That makes B to be the correct option. Next, under IFRS, if the lessor classifies a lease as an operating lease, he still holds on to the title of the lease, so the lease asset appears on the balance sheet of the lessor. A. An employer offers a defined benefit pension plan and a defined contribution plan. The employer's balance sheet is most likely to present an asset or a liability in case of defined benefit pension plan. Remember, only defined benefit plan has a funded status that would appear on the balance sheet either as an asset or as a liability. The difference we discussed a little while ago in an MCQ. But defined contribution pension plan, it is charged to income statement and shown as an expense for the period. So it means only the defined benefit plan is reported either as an asset or as a liability. Net pension asset, if your fair value of pension assets are greater than the expected benefit obligation, and a net pension liability if your expected benefit obligation are greater than the pension assets. So this is we discussed a little while ago. So that makes A to be the correct option. Next, a bond is issued with the following data. 10 million is the face value, 9% coupon, market rate is 8%, 3 years bond with semi-annual payments. Okay. Assume market rates do not change. What will the bond's market value be 1 year from now and what is the total interest expense over the life of the bond. Now, first of all, we have been given these numbers, face value. Let us calculate the PMT. PMT is going to be 9 by 2, that is 4.5% of what? Of 10 million. So it's going to be 0.45 million. This is the interest payment. Interest per period is 8% for the whole year upon 2, that is going to be 4%. And the number of periods, N, 3 times 2, 6. FV, PMT, I is given, N is given. If you plug all these, you will get the present value, which will come as 10,262,107. All right. Now, what is needed? We need to calculate the value of the bond in 1 year plus the total interest expense over the life of the bond. So what's going to be the interest expense? Interest expense is going to be 450,000 every 6 months, and there are 3 years period, that means 6 biannual payments plus the 10 million par. This is the whole paid to the bondholders, interest plus the par, the face value of the bond, minus the present value, which we calculated to be 10,262,107. So the difference between the interest paid plus the par minus the present value of the bond, this will be interest expense. So if calculating the difference, it will give you 2,437,893. So this would make either A or B to be the correct option. Now we have to calculate the value, the carrying value of the bond at the end of year 1. Now things are going to change a bit. Face value is 10 million. Number of periods, 2 are gone in the first year, 2 biannual periods now. N is going to be 4, remaining 2 years. Payment still stays the same, $450,000. Effective interest rate 4%. Plug in these numbers. You will get the market value of the bond at the end of year 1. This PV at the end of year 1 is the market value at the end of year 1. So it's going to be 10181,495, and that perfectly matches with the option B, and that makes B to be the right. Next question, number 48. A company redeems 10 million of bonds that it issued at par for 101% of par, or 10.1 million. In its statement of cash flows, the company will report this transaction as, since bonds are redeemed, so it's an outflow. It's a financing outflow. So 10.1 million will be reported as a cash flow from financing activities. Remember, cash paid to redeem bonds, it is classified as a financing activity. Next. An IFRS reporting airline leases a new airplane from its manufacturer for 10 years. For financial reporting purposes, the airline must record an asset and a liability on its balance sheet. It's correct. Under IFRS, an asset and liability to be recorded on the balance sheet unless the lease is short term, which it is not, or a low value lease, which it is not. So it will be reported as an asset and liability. That picks A to be the correct option. Next. A $1,000 bond is issued with an 8% semi-annual coupon rate and 5 years to maturity. When the market interest rate was 10, what is the initial liability? We have to find the present value of the bond. So face value is 1,000. PMT, interest payment is 8% by 4% times 1, that's $40. Periods, 5 times 2, 10 periods. Interest rate per period, 10 by 2, 5%. Plugging all these numbers to calculate PV, press CPT, PV in your financial calculator. You will calculate 922.78 as the present value of the bond to be recorded on the balance sheet. That is approximately A, and that makes A to be the correct option.